Well, good afternoon and welcome to our High Rock weekly client webinar. If you want to skip over any part of this webcast, feel free to use that fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I am Scott Tomlinson, and joining us on the call today is my partner and colleague Paul Tepsich, the founder of High Rock. Our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson, has taken a short leave following the birth of her first child. She does remain on call to us for her expert advice should we need it for you. And each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit the homepage on our website and click on the Introduction to High Rock Private Client button. Well, in the June edition of the Small Investors Protection Association monthly newsletter, High Rock was singled out and recognized for our leadership role in the investment industry as a new breed where fiduciary responsibility and the client's interests are our first priority. We think that this is a really important part of the conversation about wealth management. And yesterday, one of our clients decided to go public on LinkedIn, expressing his very favorable view of what we are doing. Among his accolades, he stated that we were building a brand that was based on doing the right thing. We do not have outside shareholders to answer to. We do not have sales or revenue targets to meet. We do have our own money invested in the exact same assets as our clients, so we will do for you what we want to do for ourselves, and that's grow our money, but always managing risk first. We may not always perform exactly with the stock markets at all times, especially if we deem that there is too much risk inherent in doing so. Last week, we talked in some depth about risk and why managing risk is so important to us. Now, the historical correlations that have made balanced portfolios of stocks and bonds a relatively safe way to invest are changing. There is a great deal more risk in these portfolios now and a lot less protection. That is why we need to be more tactical with our investing process. In Canada, bond yields have soared and prices have fallen, and stock prices have not moved with them to provide an offset. So balanced portfolios are showing losses, especially if they are overexposed to Canadian stocks. Paul, I'll let you talk a little bit more in detail.
Well, actually interesting you pull this chart up today, Scott, because government bonds around the world, for some reason, I've talked to a buddy of mine at Morgan Stanley in New York and trying to figure out what's going on. But government bonds have rallied, prices up, yields down very substantially today, and I'm not too sure why. Just to give you an idea, and Canada 10-year bonds have rallied the most of any bond in the G20 world in North America or Europe. Some of the bond yields in Europe are 5 to 8 basis points stronger today. That's 0.08, 0.05. Canada is 10 basis points stronger. That's a huge, huge day. I don't know if some of this is just because the bond market has sold off so dramatically over the past month, or there's something else more sinister about this move. But as you talk about, there's always sort of a flight to quality when risk assets like stocks get nervous. Money flies into the flight is into quality, i.e. government bonds. So right now on our correlation charts, it's not showing the positive correlation that we want to see, actually. So this could be interesting. It'll be interesting the next couple of days to see how these government bonds respond and why they're doing what they're doing today. It's a bit of a mystery.
Yeah, I'm going to argue that one part of that may be that bond investors are saying, okay, well, there's not a significant amount of inflation currently in the global economy. Perhaps the weakness in bonds, the higher yields have given us more than the premium that we require to be investing, especially in the long end. That could be one aspect of it. Another thing, we saw some data out of the United States. We'll talk about a little bit of that in a second, but it wasn't showing a really robust U.S. economic situation going forward. Perhaps that has something to do with the reason bonds were a little stronger today. And again, with Canada, you and I probably will both argue that the 10% rise of the Canadian dollar over the last few weeks has really probably put some negativity into the future for the Canadian economy, because it's equivalent to a fairly significant increase in interest rates. So you take all those things together, maybe some of that was what was coming into the picture.
Yeah, I think there's all that, and then specifically in Canada, and then in the U.S., I think whether it's the fact that the Trump administration is not going to be able to get things done nearly as quickly as they thought, which I argued with this guy at Morgan Stanley, saying if that were the case, then stocks would have sold off substantially, and they are up today again. So bonds have independently, and that's what the correlation chart shows. Stocks went up today, bonds should have sold off. I'm guessing maybe the amount stocks are up maybe a couple basis points, and they rallied 10. That's like a 12 basis point swing in Canada anyway, and about 5 or 6 in the US. So very strange. I don't know what exactly is happening, but it does bear watching.
Yeah, absolutely. Thank you.
And there were some big flows in the U.S. too. And in fact, Scott, just to last point on that comment or that slide is there was a huge rotation out of stocks into bonds. Now, again, stocks didn't really sell off, but there was a big rotation going out of stocks into government bonds. And as you said, maybe they sold off enough the past month that it's dragging some buyers in.
Well, it's clear that having a more tactical approach is part of what allows us to not have to depend on the old correlations. And obviously, they don't appear to be providing the appropriate balance anymore, or certainly at this particular point in time. But it seems to me that we're seeing more of these swings that we just don't know what they are all about. And of course, we remind everyone listening that historical returns are no guarantee of future returns. But as you know, at HighRock, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that you can ensure that your long-term goals are still in line with your portfolio strategy, and that our forecast for your net worth into the future are up to date and heading in the right direction. If you would like to review any aspect of your portfolio or wealth forecast, please do not hesitate to reach out to us. And by now, you all know our key themes for 2017. Avoiding risk when risk is high means being more tactical inside an investment portfolio. Price stability is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant of central bank policy. The Bank of Canada raised rates a few weeks ago. The Bank of England and the European Central Bank have dropped hints that they're reviewing their easier monetary policy situation and ready to begin the process, perhaps, of reversing it. And the U.S. Federal Reserve has raised rates by 0.75% since December, and is now expected that they may raise them again in December. That would be a full percentage point over the course of a year. And rising borrowing costs and reduced financial system liquidity may actually increase volatility going forward. We've certainly seen increased volatility in the bond market recently. Stock prices and valuations are close to their highs, but without more significant earnings growth, we don't believe that they can go much higher. That certainly leaves them vulnerable to a correction, and economic growth just does not appear to be supporting current valuations. The Trump agenda has so far failed to bring a new healthcare option and impeded progress on fiscal stimulus, as Paul mentioned before. We've got Brexit negotiations, NAFTA renegotiation. There's continued tensions with North Korea, certainly with Russia and the Middle East, as well as global cyber attacks and terrorist threats, all adding up to a blend of political uncertainty that confronts us on an ongoing basis. Well, the evolving inflation story is one of our important themes for 2017 as we try to assess the implications for central bank monetary policy, as I mentioned, and what may happen to interest rates. And if economies are growing, inflation should be growing, but this does not necessarily appear to be the case at the moment. And as we know, all central banks have a mandate to maintain price stability. Interest rate and monetary policy are used to keep inflation at targets at or about 2%. Currently, only the Bank of England is dealing with inflation above that level. The difficulty at the moment, obviously, is trying to forecast inflation, which has remained well below target for some time. The U.S. Federal Reserve and the Bank of Canada have determined that inflation should soon be picking up and have taken steps to get ahead of that. We think this, in fact, may be wishful thinking and that they could actually be slowing an economy already in the late stages of the cycle. Paul, do you care to comment on that?
I think that's exactly what's going to happen. Actually, I'm going to write a blog on this tomorrow, but talking about the potential for certainly the Bank of Canada and the Fed as well, raising rates prematurely in effectively a disinflationary environment, and arguably one that, let's hope it doesn't, but if it does turn into a deflationary environment, it's going to be really bad. So I think these two central banks and possibly the ECB and Bank of England hiking rates prematurely could be something to think about and prepare for.
Thank you. Today's U.S. personal consumption expenditure core price index, which is what the Fed does target, came in at a 1.5% increase over the last year. And that's still below, well below the Fed's 2% target, which is the red line that you see on this chart.
Well, not only well below, it's come off pretty hard the last 6 months too. We were hovering up around 1.8, 1.9, pretty close to their target, and now look at it.
Yeah, exactly.
It's going the other way, and the Fed's going the other way, thinking of hiking rates again.
Yep. And another bit of data that we got today was U.S. consumer spending. As we know, the U.S. Consumer is 2/3 of the U.S. economy. And as we see this chart, you can see that from a month-to-month view, the swings can be rather erratic. But if you look at the longer-term trend, which we've got here in pink, it does show that consumer spending peaked early in 2015 and has been trending lower ever since. So from this angle, it is hard to see growth heading into the future and higher levels of inflation that would certainly follow that. So when debt service costs are rising faster than wage growth, I would have to think that the consumer is looking a little strapped. And I know we also got a whole bunch of data from the U.S. auto industry today. Paul, do you have any comment on that?
Yeah, auto sales are down. I mean, that combined with the fact that dealer inventories I think are extremely high, and haven't seen the data. I'm not going to say an all-time high, but I think they're extremely high, which is not good. And with consumer spending kind of trending a little bit lower here. And the other thing in the auto industry is the amount of structured product that exists in auto loans and leases, where they package up, just as they did back in 2005 through 2007, packaging up mortgages. They package up auto loans and leases and securitize them into security product, like almost effectively like a bond, and sell them to institutional and retail investors. I think those default rates are starting to tick up on those securitized bonds.
Yeah, so, we talked a little bit about that a few weeks ago, and that's exactly what the case has been.
Yeah.
And there is some concern, and interest rates are going up in the United States, and debt servicing costs are, as we said, getting a little higher. So that could be what's impacting consumer spending to a degree. Well, we talked a little bit about the the Canadian dollar, and certainly when the Bank of Canada changed its course on interest rates, a lot of traders and speculators were caught off guard. The Canadian dollar has moved higher against the U.S. dollar by about 10%. We actually thought it was a reasonably good time to make some purchases. Paul, do you want to talk about that?
Yeah, I think with the fact that this Canadian dollar rallied, 10-odd%, as you point out in red, over the past couple months, it was really on the back of the Bank of Canada and a few senior deputy governors there frothing on in speeches about hiking interest rates, and lo and behold, they did. And that's what drove the currency and the Canadian dollar stronger, which we look at the currency and the way it trades in the interbank market, which is on a spot, called a spot basis, the US dollar versus Canada. So as you can see, it was up around 138 back in April, and it bottomed out at 124 the past week. If we're right, and we think the bank is hiking rates prematurely, and we've got some issues with the housing market, which is 23% of our economy, we've got oil, which is still extremely volatile in arguably a tighter range, but it's volatile. We could have some issues in Canada, and owning some U.S. dollars against Canadian dollars, which is what we did late last week. We bought U.S. dollars, helps provide all of our portfolios with a natural or passive hedge to the other risk assets which we own. So it's a very important risk measurement tool that we use. And I think we got a decent, actually today, right now, Scott, it's at 125.45. So, we made almost a point so far on this.
Oh, that's not so bad. And another thing too is that there are some U.S. dollar denominated assets that we want to buy for our clients, and we don't want to buy them at their current levels. But if they do start to come off, we've already got U.S. dollars in place to take advantage of, what we consider to be a reasonable price for the U.S. dollars. And we can certainly put those U.S. dollars to work when those asset prices come lower as well, right?
Yeah, because if those asset prices come lower, chances are that U.S. dollar is going to be higher, and it could be back up towards 133, 135, somewhere in there. And we don't want to be buying the U.S. dollars at that level. So it could still gravitate towards 121, but we don't think so. So I think we made and I guess we should add, Scott, that we purchased a certain amount of U.S. dollars, and we still have a little bit more to buy. If the U.S. dollar continues to go lower and the Canadian dollar is stronger, so it goes towards 121, 1.21 that is, then we'll buy the balance that we need, right?
Yep, that makes sense. I mean, everybody should have somewhere in the vicinity of 15, 16% of their portfolio right now in U.S. dollars. Another thing, while we're talking about the U.S. dollar, some of our clients have U.S. dollar needs over the course of a year, and we talk about this. I've written blogs on this. The last thing we want our clients to have to do is end up going to a bank or actually using a Canadian credit card where they get charged outrageous exchange rates by the banks and the credit card companies. So remember, you do have U.S. dollars in your portfolios. We can always get better rates when we're buying U.S. dollars. So the natural thing is to just get a U.S. dollar credit card and have a U.S. dollar bank account. We can send U.S. dollars to your bank account, and you can use that to pay your U.S. dollar credit card. And that way you avoid what we would consider to be usurious rates that banks and credit card companies charge. So keep that in mind. I think that's a pretty important way to just keep your costs of any travels that you do down. Well, we also paying, as we mentioned, close attention to the global debt situation and borrowers' ability to service that debt when interest rates move higher. It certainly becomes a bigger issue, and global debt levels continue to be moving up at record levels. And of course, you all know because we've been saying it for a long time. We think stocks, especially U.S. stocks, are expensive. Earnings are expected to grow only at a rate of about 6.5% over the course of the next year, but stocks have already built in a 27% rate of growth above the 10-year average. So again, we think stocks could be very expensive. And another metric that we use, that we talk about each week, is enterprise value to EBITDA, as expensive as it was at the time of the dot-com bubble. I won't go on anymore about those. We do keep an eye on what's going on the geopolitical front. As I mentioned before, and Paul mentioned, the Trump administration is struggling to move its agenda forward. The Republicans are leaving town for an August recess after a failed attempt to repeal the Affordable Care Act, otherwise known as Obamacare. When they return in September, they'll only have 12 working days to avert another big problem. In a letter to lawmakers on Friday, U.S. Treasury Secretary Steve Mnuchin said the federal borrowing limit, or debt ceiling, needed to be raised by September the 29th, or the government risked running out of money to pay its bills. Now, we've bumped up against these issues in the past, and normally they do get solved, but they do tend to play it out to the last minute. So again, expect a little bit more drama as we get to that date. Keep it in the back of your mind, late September. And China lashed out at the U.S. Yesterday over North Korea, saying Washington is ratcheting up tensions with Pyongyang and violating Security Council resolutions that call for restraint and dialogue. And today, Secretary of State Rex Tillerson said that the U.S. does not seek to topple the government of North Korea and would like to have a dialogue with Pyongyang at some point. Paul, any comments you want to make on the geopolitical issues out there right now?
None that I think you've made them all. I'm increasingly more nervous about the geopolitical situation, especially with North Korea. I think the U.S. is test firing an ICBM off the coast of California later tonight. I don't know if this is just posturing, and specifically with China, to do something about North Korea, but and I think that's part of what's going on in the bond market today. So it's probably the biggest part of what's happening in the bond market. So where you get that flight to quality or flight to safety of government bonds, if there is some sort of really adverse war effect. But I don't have anything else to add, Scott.
Yeah, I had this discussion with a fairly well-known business writer, columnist on the weekend, and it was one of his big fears too, was that things get out of hand with somebody like Trump, who seems to be a little bit more fly off the handle kind of situation or person. And personally, I'm more of an optimist. I hope that the cooler heads always prevail. The smart people tend to understand that if we get into any kind of shooting match, that losses are inevitable, and nobody wins really from that perspective. So hopefully the smarter minds prevail through all of this, and the diplomatic process works. But again, well, it's a concern.
You can be positive and an optimist, but we should probably let our clients know that we do try and take care of the downside and prepare at least part of our portfolio to be hedged up should there be some sort of black swan type event, like ICBMs being fired off. And I think we are pretty well prepared for that at this stage.
Yeah, and that was what I was going to say. We as we always say, we manage risk first here, and that is a risk that's out there, right? And as we're talking about that, we continue to desire to get portfolio growth through all of our models, but we're uncomfortable with risk at current levels, especially in the equity market, as we've mentioned. We think the U.S. economy is in its late stages, and we're uncomfortable with that. But as we just talked about, the geopolitical situation creates lots of uncertainty too. And we've all worked too hard for our money to make sure that we want to make sure that we're investing it prudently. Okay, well, that's it for this week. Once again, we want to thank you all for taking time out of your busy schedules to tune in. We have been trying to make this webinar a bit more of a dialogue, focusing on topics that we think are worthwhile, but we would certainly appreciate any of our listeners' ideas of what you might want us to discuss. Feel free to send us an email, give us a call, whatever you're comfortable with. But all that being said and done, we will be back with our next update next Tuesday. So until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week, and for those of you who get one, a wonderful long weekend coming up.